Welcome back to the deep dive. Today, we're doing something a little different. We are pushing aside all the noise.
Yep. No news, no earnings reports.
None of it. We are looking at what you might call the purest form of truth in the market. We have just one image in front of us. It's a weekly candlestick chart for SBN, the State Bank of India.
In this chart, it really tells a story. We're looking at a span from, 2018 all the way to right now, February 2026. It's a thriller, honestly.
It really is, and for everyone visualizing this with us, just picture a dark background, these bright green and red candles. It starts kind of low and flat on the left, and then just this massive mountain climb all the way to the top right.
It's the whole hero's journey in a stock chart. We're not just looking at price. We're looking at, the stock's heartbeat through things like volatility, momentum, and volume.
And this headline here, the big takeaway right from the start, is that we are sitting at a record high. The stock literally hit its peak this week.
Yeah, the chart shows a high of 1089.80, which, when you look at where it started on the left side of the chart,
It was struggling to even break 300 back then. The difference is just staggering.
it really is. But you can't appreciate that summit without looking at the base camp. And honestly, that base in 2018 and 2019, it looks exhausting.
Exhausting is a good word for it. It's just chop. That's
Yeah.
the only word. It's stuck between, 250 and 350 for almost 2 years?
And that's by design. We call that an accumulation phase. It's supposed to be boring. It's meant to flush out anyone who's impatient.
So the retail guys get frustrated and sell.
They do. They get tired of it going nowhere and they sell. And the institutions, the so-called smart money, they just quietly buy it all up without making the price spike. They're coiling a spring.
But before that spring uncoiled up, it sort of exploded down. We have to talk about that crater in the middle of the chart, 2020.
Ah, yes. The COVID crash.
Yeah.
Visually, it just breaks the entire chart structure. It's violent.
It really is. The candles just fall off a cliff. It slices right through that 250 support level like it wasn't even there. It goes way down.
It bottoms out somewhere around the 150, maybe 160 mark. A catastrophic drop.
Yeah.
But this is where the technicals get really interesting. Look at the Bollinger Bands during that drop.
Those are the green lines that kind of hug the price.
Exactly. They measure volatility. And in early 2020, look at how wide they blew open.
Wow. Yeah. It looks like the mouth of a hippo just opening up. A massive expansion.
That's extreme volatility. It's panic. The price crashes right through the lower band, which is statistically a very rare event. For a contrarian, that's a huge signal.
And that brings us to the fuel gauge at the bottom, the volume.
Yes. Okay. So you look at those vertical bars right under the 2020 crash. What do you see?
They're like skyscrapers. They're 2 or 3 times higher than almost anywhere else on the chart.
That right there is what we call capitulation volume. It is the sound of everyone giving up at the exact same time. Maximum fear.
But for every seller, there has to be a buyer.
Precisely. So while a record number of people were panic selling at 160 rupees, someone with very deep pockets was buying record amounts. That volume spike is the foundation for this entire bull run that follows.
It's amazing. That moment of absolute terror was actually the moment of maximum opportunity. And from that point on, the whole trend just flips.
The whole narrative changes. We enter what you call the Great Ascent.
And it is a climb. You see it start making higher highs, higher lows. It gets back above the old levels pretty quickly. But it wasn't a straight line up to 1,000, was it? I see a messy patch in 2021, 2022.
Right. And this is another trap. After that big recovery, the market needs to breathe. So you get more sideways chop, this time between maybe 400 and 600.
Another boring phase.
Another boring phase and another test of your conviction. The trend isn't broken, but it's pausing. The Bollinger Bands actually squeezed tight again here. Volatility dried up. The market was waiting.
And it definitely got what it was waiting for. Starting in 2023, the angle just gets steeper. It takes off.
This is the markup phase. The public gets interested again. And now look at how the price interacts with those Bollinger Bands in 2024, 2025, and into 2026.
Yeah, this is cool. In 2020, it fell out of the bottom of the bands. Now it's like literally surfing the top green line.
We call that walking the bands. Normally, the upper band is resistance. The price is supposed to hit it and bounce down. But in a really strong trend, the price just pushes the band higher and higher. It refuses to come down.
So that's super bullish, but doesn't it also mean the stock is, kind of overextended?
It does. Statistically, it's trading at the very edge of its range. It's expensive.
Hmm.
But a strong trend can stay that way for a lot longer than you think. It's a sign of immense buying pressure.
Okay, so that brings us right up to today. Let's dissect this very last candle on the far right, the week we're in right now.
Right, the now. Let's look at the anatomy of this weekly candle.
Okay, I'm looking at the data. The week opened at 1076. It pushed up and made a new all-time high of 1089.80.
So we were knocking on the door of 1100.
Exactly, but it took a hit. A serious one. The low for the week is 988.3.
Now hold on there. Just think about that. From almost 1090 down to 988 in the same week. That's a 100-point drop. It's a nearly 10% correction in just a few days.
Which sounds terrifying. If you bought at the top, you're instantly down big. And it broke below 1,000.
Right. And breaking that big round number, 1,000, that usually triggers a lot of automatic selling.
And this is the key. It did not stay down there. The week closed at 1066.40.
That's the whole story. Look at the shape of that candle. It has that long tail or a wick sticking out of the bottom. That wick means rejection.
Rejection of lower prices.
Precisely. The sellers, the bears, they tried to push it down. They hit those stops below 1,000. But instead of a collapse, a swarm of buyers came in and said, thank you very much. They saw it as a discount and bought it all the way back up.
So that little wick is like a footprint. It shows the smart money stepping in to defend the trend.
It is a signature of strength. It tells you the underlying demand is still there, even at these highs.
So how does this square with the engine room, the RSI indicator in the middle?
The relative strength index. Well, back in the 2020 crash, you can see the white line was buried, down near 23. That's deeply oversold.
Okay, that makes sense. It confirms the panic. But what about now? It's way up high, near the 70 line. Isn't that overbought? Shouldn't we be worried?
That is the classic textbook mistake. In a flat, sideways market, yes, 70 is a sell signal. But in a powerful uptrend like this one, the RSI's whole range shifts upward. It can live between 60 and 80 for months.
So it's not a warning sign?
No, not yet. It's actually a confirmation of the momentum. The warning sign, the divergence we look for, is if the price makes a new high but the RSI fails to. Right now, they're both strong. The engine is running hot, but it's running.
And the volume on this most recent climb, does it look like those skyscrapers from 2020?
It's different. It's much lower, much steadier, which is normal. You don't need panic volume for a trend. You just need consistent buying. I do see a few spikes when it broke through big numbers like 800 or 900, which is healthy. It shows new buyers are still coming in.
So if we put it all together, we have a stock that's in a clear uptrend. It's riding the upper Bollinger Band with strong RSI. And this week's candle shows that buyers are aggressively defending any dips.
It's a very, very bullish picture. But we also have to ask, how does this end?
Right. Because trees don't grow to the sky forever.
Exactly. And the air gets thinner the higher you climb.
Right.
At some point, this thing has to take a breather.
So what's the first warning sign you'd look for on this chart? The canary in the coal mine.
For me, it would be a change in the character of the volume. Right now, buyers step in on the dips. The danger signal would be a big drop on a spike in volume, a big red candle with a huge volume bar like we saw in 2020. That would suggest the institutions are now selling, not buying.
And that RSI divergence you mentioned, if the price hits, say, 1150 next month, but the RSI is lower than it is today.
That would be a major red flag. It would mean the momentum, the force behind the move is fading.
But as of right now, February 8th, 2026.
The trend is your friend. It is unequivocally up. Until the structure of higher highs and higher lows is broken, you have to respect the momentum.
It's just a fantastic case study, from the depths of fear and capitulation around 150 to the euphoria at nearly 1100.
And this brings up a final thought, I guess. We've seen what happens when the price rides that upper Bollinger Band. The question now isn't just how high can it go, but something else.
Oh, what's that?
What does the volume look like the next time the price falls and seriously tests the lower Bollinger Band? That will be the true test of this entire 6-year trend.
A question for another day. This has been fascinating. Thank you all for joining us on this deep dive. Hopefully you see a bit more of the story behind the squiggles on the screen.
Keep your eyes on that volume.
We'll catch you on the next deep dive.